The United States experienced excitement in the initial days following the Federal Reserve's eagerly anticipated decision to lower the key interest rate. Investors boasted of a new era of growth, markets jumped, and Trump administration officials hurried to declare it a win over inflation. But it was only a matter of days until the dust settled. The analysts' icy calculations have out now that the emotions have faded. The predictions proved to be far more dire than the White House had anticipated. The Financial Times and Bloomberg Economics claim that the rate cut was more of a hurried decision in the face of mounting issues than an indication of assured control of the circumstances. Economists observe that concerning indicators are emerging as markets adjust. The inflation rate is beginning to rise again. Prices for necessities like bread and milk are already going up in some areas. Fuel and beef. Prices for basic product categories have been rising steadily in recent weeks, according to the Wall Street Journal, which cites data from Walmart and Kroger. This pattern seems to be continuing. Experts attribute this to a variety of underlying causes in addition to seasonal ones. Global market volatility, Donald Trump's trade war with China, overheating in several U.S. economic sectors, and a record national debt of more than $36,000 trillion, as well as dwindling confidence in the dollar as the global currency reserve. A trend that was brought to light by Nikkei Asia and the Frankfurter Allgemeine at cited is receiving particular attention. A growing number of nations such as Saudi Arabia, China, India, and Turkey are expanding their gold holdings and decreasing their proportion of dollar assets. The World Gold Council keeps track of central banks' gold purchases, which is the most obvious indication to date that the world is getting ready for turbulence. J.P. Morgan analysts point out that these actions constitute a purposeful reorganization of the financial system rather than being arbitrary. If the dollar once had no alternative, now many governments openly say that the risks linked to U.S. debt and inflation are too great to keep all eggs in one basket, stated an anonymous European bank insider. Expert circles are currently discussing if Donald Trump's administration can handle the impending problem. On the one hand, the White House maintains that the rate decrease will keep the economy afloat and encourage business. However, an increasing number of analysts contend that inflationary pressure will only increase, which could harm average Americans by driving up the cost of energy, food, and loans. According to The Economist, America confronts a new economic storm, and the resurgence of inflation in daily life is just the start. This is further compounded by the political element. American exports are suffering as a result of Beijing's retaliatory measures, Trump's trade war, and limitations on Chinese imports. Midwest farmers are already seeing a decline in their earnings, while large firms are griping about the depletion of essential component supplies. Congressional sources claim that skepticism is growing in private. Is the economic pressure tactic turning out to be too expensive? Rising food costs, a declining value of the dollar, the global gold rush, inflation, and an overheated debt market. All of them are components of a single equation that suggests an imminent crisis. This time, the focus is on a systemic shock that has the potential to alter the global economic equilibrium rather than a local recession. How the globe will handle this storm is now the key question. Global markets fell in 2008 when the crisis started in the United States. Experts from the IMF and Oxford Economics caution today that the repercussions would be much worse if America were to become the epicenter once more. This time, confidence in the U.S. financial system and the USD is lower than it has ever been. The markets are anticipating the Federal Reserve's next move. Investors are anticipating the White House's next move. Allies are also anticipating Trump's leadership. For the time being, an increasing amount of evidence points to years of instability rather than respite. The question now is not whether a crisis will occur, but rather how severe it will be and who will be able to withstand it with the least amount of damage. Experts have been concentrating on U.S. Bureau of Labor Statistics in recent days. In black and white, it indicates that the Consumer Price Index has begun to increase more quickly than anticipated in a number of places. In particular, the food market is concerning. In just a few weeks, the cost of meat and dairy products has increased by 4 to 6% in New York, Chicago, and Los Angeles. In the fuel and transportation services are becoming more costly in the southern states. When local price increases turn into a national trend, economists refer to this as the first bell. Customers sense the problem in their wallets long before statistics formally record inflation, according to a recent story in the Wall Street Journal. Public debt is also worth mentioning separately. The rate of growth is increasing exponentially, and Moody's experts have already issued a warning that interest payments on the debt may surpass defense spending in the upcoming years. This implies that the U.S. will take out more loans in order to repay its existing debt. According to a Financial Times specialist, gold figures are equally concerning as a traditional debt trap. The reserves of China's and India's central banks have grown by almost 300 tons since the year began. Similar actions are being taken by Turkey, Saudi Arabia, and even Poland. According to Nikkei Asia, we are seeing a slow but irreversible trend of dollarization. People around the world are losing faith in the dollar as a stable currency. Additionally, the U.S. inflation rate is directly related to this process. States seek protection in metal that has been used for ages, with each new dollar emission has represented worth. Significant investment bank insiders quietly acknowledge that the market is starting to seem more and more like the 1970s, when stagflation occurred in America amid an oil shock and geopolitical unrest. The economy thereafter entered a protracted crisis as price increases accompanied a decline in production. We observe the same symptoms now: reducing GDP growth, escalating inflation, volatile financial markets, and waning dollar faith. Reuters was informed by a senior Bank of America manager. Numerous observers stress that politics as much as economics are to blame. Trump's trade conflict with China increased the cost of imports, which in turn drove up inflation. The U.S. farming industry suffered as a result of the Chinese reducing their purchasing of American agricultural goods. According to CNBC and Bloomberg, this has already caused unemployment to increase in some areas. Politico claims that there are increasing differences within the Federal Reserve. A portion of the leadership thinks that lowering the rate was a bad idea because it merely made inflation worse. Another section makes the case that the economy would have crashed considerably sooner if this action hadn't been taken. Lawmakers are already debating whether to put pressure on the Fed to take more aggressive measures in the hallways of Congress. One thing is certain, though: there is less and less space for maneuver. The world is not prepared for another crisis of the magnitude of the one that occurred in 2008, according to international analysts. At the time, confidence in the dollar and American bonds allowed the global system to save itself. That trust has vanished today. According to the IMF's most recent assessment, any significant crisis in the U.S. will unavoidably cause a systemic shock to the entire world economy, with more severe repercussions than the previous one. The question is whether Trump can provide a viable remedy and how America will weather this storm. His administration exudes confidence for the time being. However, an increasing number of analysts write that this assurance is only a front for an escalating disaster. Additionally, the U.S. will be under pressure unlike anything it has seen in decades if inflation does pick up steam in the upcoming months.